Yeah. On a lighter note, the global launch this time around is in Uganda.
Yes.
Why Uganda?
Well, Uganda actually presents an opportunity to talk through how what's happening on the commodity price shock side impacts countries like this one that is an oil importer, but is meant to become down the road an oil exporter, and how to use the opportunities of lower oil prices at this time to really build those buffers and make that progress on diversification that will help Uganda to be an oil exporter down the road that is not obliterated by an oil price shock. So it's a very interesting case to talk both about the benefits of lower oil prices, how to use those to become a more diversified oil exporter down the road.
Just to join to what you've just said, what does the fall in oil prices portend for countries like Uganda, considering that we are headed for production?
Well, as I was saying, it's an oil importer, so of course Uganda is benefiting currently from those lower oil prices. And it's a good thing. It's a good thing for Uganda. In terms of how those lower prices impact the prospects for Uganda becoming an oil exporter and the investments in the oil sector continuing, based on what we know and what we've heard, we don't see the oil price decline as adversely affecting Uganda's prospects for becoming an oil exporter. They're not undermining the investments in the oil sector, because I think oil investors in the oil sector certainly have a more medium to long-term perspective on prices. And based on what they have studied, the sense is that by the time Uganda becomes an oil exporter, oil prices would have recovered. So they continue to invest in the oil sector. Meanwhile, Uganda certainly needs to do more to move up the value chain in the agricultural sector, doing more to add value there, and to improve the business environment to elicit more private investments in other sectors, so that Uganda has a more diversified economy and is able to withstand possible shocks when it does become an oil exporter.
Okay, very interesting. As an IMF, what's your general assessment on the impact of the U.S. posture? I call it posture for increasing interest rates on Africa. The impact on Africa.
Well, as we saw in the first quarter of this year, after the U.S. Federal Reserve did increase interest rates in December, certainly there was a bit of volatility on the international markets, and the financing conditions for African countries, those frontier economies approaching financial markets and hoping to issue sovereign bonds. I mean, the financing conditions tighter, more difficult. We've seen increases in the rates that countries can get. So it's been certainly an impact in that regard, and certainly the sense that there will be additional increases in U.S. interest rates down the road. And given some of the uncertainty on the global environment, one cannot, think that there might not be additional volatility. So perhaps there will be, and countries need to be prepared for that. Our advice is to not try to withstand these changes on the global front, say by using scarce reserves to try to shield currencies from depreciating. And so to really be certainly attentive to the global side, and to make sure that countries are prepared to respond, but in a way that certainly saves their buffers and allows both monetary and fiscal policy to play a role. But in the last 6 months, we've seen an appreciation of the exchange rate in Uganda. And our sense is that Uganda's exchange rate is currently consistent with fundamentals. And we certainly encourage the authorities to continue to manage the exchange rate and monetary policy in the very effective way they've done so far.
Okay.
Yeah.
Last question. I was given an indication. What are the biggest risks to sub-Saharan African growth in the medium term, and where might opportunities be to spur growth?
Well, you know, the shocks and the developments, the factors that are leading to a weaker growth that we're likely to see this year, commodity price decline, rebalancing in China, you know, developments on the financial markets, tighter financial markets. All those may be factors that are prolonged, and that's a big risk that you know, they may remain as difficult as they are, and that would continue to impact sub-Saharan Africa. That's one set of risk. But I think the risk we're most concerned about actually is that countries most severely hit by these commodity price shocks don't respond in a timely fashion and don't adjust in a timely fashion, and in that way increase the risk of more difficult financial conditions down the road and a more disruptive adjustment. And that's why we're calling for a policy reset quickly in those countries to make sure that they work to safeguard all of what has been achieved in sub-Saharan Africa in the years past.
Okay. Thank you so much.
Thank you.
It's been so nice.
Thank you very much.
Small world again.
I know.
Yeah.
Good to see you
Me
again.
too.
Thank you.
Yeah.